Hey everyone, welcome back to the Investing Iguana. Today, we're diving into a hot topic that's rattling markets worldwide, intensifying trade tensions and the resulting market volatility. But here's the twist. Instead of running for cover, what if this crisis is actually a rare chance for Singapore investors to get ahead? Let's unpack why OCBC's Carmen says, "Don't waste a crisis," and how Singapore's blue chip stocks might just be your best bet right now. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, retirement planning, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of December 2024. I also focus on regional and global economic trends. First, let's set the scene. The US-China trade war has flared up again, with tariffs flying back and forth. President Trump's latest move saw tariffs on Chinese imports jump to 125%, and China quickly hit back with their own countermeasures. Markets across the globe are feeling the heat, and Singapore's Straits Times Index, our STI, hasn't been spared. In fact, the STI recently saw its biggest drop since 2020, tumbling 3% in a single day. For many investors, this kind of volatility is nerve-wracking, especially since Singapore's economy is so tightly linked to global trade. Our exporters, from electronics to shipbuilding, are already bracing for impact, and policymakers are warning that Singapore could take a bigger hit than most if this trade war drags on. But here's where the opportunity comes in. When markets panic, prices fall, even for the strongest companies. Carmen points out that Singapore's blue chip stocks, the heavyweights of the STI like DBS, OCBC, UOB, Singtel, and Keppel, have seen their share prices drop to much more attractive levels. These aren't just any companies. Blue chips are like sturdy ships in a stormy sea. They're large, established, and have a track record of weathering economic shocks. While smaller firms might struggle to stay afloat, these giants are built to survive and even thrive when conditions improve. Let's look at why blue chips are so compelling right now. First, resilience. These companies have strong balance sheets and diversified businesses. For example, DBS just reported a record net profit of $11.4 billion last year, and its return on equity hit 18%. That's world-class performance, even in tough times. OCBC and UOB are also sitting on solid fundamentals, and Singtel continues to generate stable cash flows from its regional operations. When the going gets tough, these are the companies most likely to bounce back first. Second, value. Because of the recent sell-off, blue chip stocks are now trading at prices we haven't seen in a while. For investors with a long-term view, this is like walking into a sale, where the best brands are suddenly much cheaper. And it's not just about price. The STI's dividend yield is now close to 5%. That's higher than most fixed deposit rates, and even beats what you'd get from many global stock markets. For context, the S&P 500 in the US is yielding about 1.4%, and the Hang Seng in Hong Kong is around 3.4%. So Singapore's blue chips are offering both stability and income, a rare combination. Third, dividends. Singapore blue chips are famous for their reliable payouts. Whether it's DBS, UOB, OCBC, or Keppel, these companies have a strong track record of rewarding shareholders with regular dividends. For many Singaporeans, this is a big deal, especially if you're looking to supplement your CPF savings or build a steady stream of passive income. Some, like Keppel, are even yielding above 5% right now. These payouts can cushion your portfolio during rough patches and help you ride out the storm. Another sign of confidence? Share buybacks. Several blue chip companies have been actively buying back their own shares after the recent market drop. DBS, for example, launched its $3 billion buyback program, and others like ST Engineering and Venture Corporation have followed suit. When management is willing to put their money where their mouth is, it's a strong signal that they believe their shares are undervalued and that the business fundamentals remain solid. So, what does this all mean for Singapore investors? First, don't panic sell. Volatility is uncomfortable, but history shows that blue chip stocks tend to recover and often come out stronger. Second, look for value. Corrections like this don't come around often, and they can be the best time to buy into quality companies at a discount. Third, focus on dividends. Reliable payouts can help you weather the ups and downs, and Singapore's blue chips are among the best in the world for this. Finally, stay diversified. While blue chips offer stability, spreading your investments across sectors and companies further reduces your risk. To sum up, Carmen Lee's advice is clear. Use this crisis as a chance to invest in Singapore's strongest companies at better prices. Blue chip stocks are built to survive storms, and for investors willing to look past the short-term noise, this could be an excellent opportunity to build long-term wealth. Remember, in investing, it's often the calmest heads that win in the end. Thanks for tuning in to the Investing Iguana. If you found this analysis useful, don't forget to like, subscribe, and share your thoughts below. What blue chip stocks are you watching, and how are you navigating this market turmoil? Until next time, stay calm and invest smart.